Hi, good morning, everyone. Can you guys hear me and see my screen? Right, if you guys can, just drop a quick comment in the question box below with a quick yes or letter Y. All right, thanks Usman, thanks Fernandez. Right, well, good morning to all of you. Thanks Hyung-Ryu. Right, okay, so today we are going to be covering the Avramis ribbon strategy. Now, before I begin, all right, this is just a quick introduction. Okay, this is really a collaboration between Everest Fortune Group and XM.com. Right, so the curriculum is actually produced by Tripedia. This gentleman over here, Mr. Avramis Despotis. So we are actually covering on behalf of him. All right, so today is a very interesting strategy, very interesting sharing is actually the Avramis ribbon strategy. So it's really a strategy that is developed by Mr. Avramis over here. Okay, so if you actually write into the XM.com customer service, right, where the customer support, you can actually ask them, you know, if you guys can, for the live XM clients, you can actually ask if this Avramis ribbon strategy is actually available for you. All right, so I'm going to give about a minute or two, just a minute for more participants to join in, and then I will begin proper. All right, likewise, if you guys already know, my name is Isaac. Okay, I actually do cover with my colleagues the 135 live session every now and then, right? The XM exclusive webinar series. So if you guys know my style, it's really there's really no Q&A at the end of the entire presentation, right? I like to keep things interactive. If you guys have questions, feel free to ask me along the way, and I will do my best to actually reply you guys where possible. All right, so since we have a healthy number of people in the room, let's begin proper. Okay, today we are covering Avramis ribbon strategy. As mentioned earlier, it really is a strategy that is developed by Mr. Avramis Despotis, this charming, smiling gentleman, the picture that you see over here. So what we're going to be covering for the webinar today, very simply, we'll be talking about moving averages, which really is the foundation of this strategy. And then after that, we'll move on to talking about the MA ribbon, right? So putting together the concepts that we have covered on the moving averages into how it fits together into to come together as a ribbon strategy, right? And then of course, I'll share with you a bit of Mr. Avramis' entry signals on how to use this moving average ribbon strategy, how he uses it to enter, right? And how he looks for entry and stop loss levels. All right, so now before I really dive into moving average, I just want to get a sense, right, of the people here in the room, right? What is your experience level when it comes to trading? What is your experience level when it comes to using indicators? Okay, so if you're new, just say you're new. If you have 1 to 3 years experience, you can put 1 to 3, or if you have more than 1 to 3 years experience, you just put more than 3 years. All right, so we have some who are saying that, you know, really new. Give me a moment, I need to adjust my mic so that you guys can hear me properly. All right, so yeah, okay, so some of you are saying new. There should be, I see some familiar names over here, so you guys should actually have at least 1 to 3 years experience as well, right? So fantastic. Okay, so I would actually cater it to the new crowd. Okay, I bear with me, those who are slightly more experienced, right? I'm going to just go through the basics, take a bit more time on the basics so that you guys can really understand how this moving average works. All right, so moving averages is actually a very common indicator. In fact, when you start out trading, right, a lot of you will definitely come across, oh, let's look at a moving average indicator, right? There is this thing known as the golden crossover, right? The golden cross On the other side, there's this other thing known as the death cross. Okay, so what is this golden cross? What is this death cross? What essentially is the moving average? Okay, it can be a lot to take in for traders who are new, right? So I want you guys to know, right? Rest assured that moving average is really not a tough concept to understand. It is relatively easy. Okay, and if you know this first point here, right? If you know this first point here, you will immediately know when is the right time to use moving average already. Okay, so first and foremost, right, the very, very important point that I would like to make is this point over here, that moving average is a trend following indicator. Now, what does it mean by trend following? Okay, the market moves only in 3 directions, right? Some people like to say, oh, market has 2 directions, but in actual fact, the market moves in 3 directions, right? So let me just change the pen color. I just want to show something that's clear. All right, so we have the market in an upward direction. We have the market going in a downward direction. And finally, we have market going in a sideways direction. All right, so for those of you who are new, this is essentially called an uptrend. This is essentially called a downtrend. And this is called sideways. Please forgive my handwriting. I'm writing with a mouse. Or consolidation. Okay, so it's either sideways or consolidation if markets are moving sideways, and then it's uptrend or downtrend. So the first point here is really the most important thing that you need and you must know about the moving average, is that the moving average is a trend following indicator. All right, trend following. Now what this means is that moving averages only work, okay, when we are in a uptrend or downtrend market. All right, moving averages do not work in a sideways consolidation market. Okay, so if you're going to use this strategy, I think this point here already tells you very clearly that moving this strategy, which is built on moving averages, is only going to work well in an uptrend and downtrend. Okay, using moving averages in a sideways market is just going to kill you. It's just going to eat away at your trading capital. All right, and it's just going to wipe your account out. Okay, so just remember the first point, very important. Moving average is a trend following indicator. All right, so once you know that the moving average is actually a trend following indicator, you will know that, okay, the moving average, because it's following, right? So when price goes up, then moving average moves up. When price goes down, then moving average goes down. Okay, so because it is a trend following, we call it a lagging indicator. All right, most indicators out there are lagging. So you guys that trade on indicators, okay, personally speaking, from my experience, okay, I only use indicators as a final confirmation, right? I never ever use indicators to tell me when to enter, when to exit the trade. Okay, so that is essentially the way I use indicators, right? Indicators for me is like a final confirmation sort of thing. Okay, so moving average is a lagging indicator. It does not predict future market action, but instead it follows it. All right, and moving average is actually used to identify the direction of the trend and support and resistance levels. Now, moving averages, all right, the primary use of it is really to identify the direction of the trend, whether it's uptrend or whether it's downtrend. Right, so it's either up or it's either down. Now, using moving average to actually identify support and resistance is a lot trickier. All right, there's a reason behind it, because, you know, if price is still moving, then the moving average is still calculating. Therefore, it will not be so accurate to use moving average as support and resistance level. Okay, so I will take this one. Okay, I will take this portion. Okay, with a little bit of salt, right? A pinch of salt. right? So just a very small, just put a bit of dots here just to show you guys it's a pinch of salt, okay? But what is important is this one, identifying direction of trend. Okay, and finally, all right, moving average can be viewed as a curving trend line. Okay, it can be viewed as a curving trend line. That is correct as well, but generally I do not like to use moving average as a curving trend line. Okay, reason because, you know, some people will use 50 moving average, some people use 200. These are the more commonly looked at moving averages, right? Some people look at like myself, you know, I look at 21, I look at 34, okay, I look at 50, 55, right? So I look at moving averages based on Fibonacci numbers, right? But some people really just look at Fibonacci moving averages on a very arbitrary number, right? So if you're going to use moving average, you need to know the reason why you're using that period. Okay, so if you know why you're using that period, then it makes it a lot easier for you. All right, so that's about moving averages. So how do we interpret moving averages, right? So now just remember, at the end of the day, moving average is for a trending market, right? So in order to understand how to use moving average, you need to learn, you need to have it anchored in your brain, right? Have it so ingrained deeply in your brain that moving average is really only for trending market. All right, so here's how we interpret bullish price crossover. All right, so first and foremost, we compare the relationship between price and moving average. So we have the market price over here in a strong downtrend. All right, there's a very strong downtrend over here. How we know that it's in a downtrend? Because you see, price is making lower highs and lower lows. Give me a moment. Lower lows, right? So you have low highs, lower lows. You know that price is in a downtrend. Okay, so we have a moving average here. Essentially, the moving average smooths out the trend. Okay, so you can see that price is sort of like a zigzag motion. Let me just change the color again. Okay, price is sort of in a zigzag motion, but the moving average is a lot smoother in one flowing motion. All right, so a good thing about moving average is that it smooths out the trend. It makes it easier for you to see whether price is going down or price is going up. Okay, now the next thing is that a bullish signal is given when prices rise above the moving average. All right, so you see now price has just popped out above the moving average. Okay, what we do is we wait for a candlestick to close, and then we wait for another candlestick to open. All right, and that is when we confirm that price has changed the trend. Okay, so a bullish price breaking above the moving average is just a warning. It's like how I say it. It's just like, hey, look, you know, this is going to happen soon, but it's not confirmed, right? So it's just like when you're driving, okay, you see a traffic light, all right? You see a traffic light that is green, and then after that, it is turning yellow, right? It's not confirmed that it's going to go to red yet, all right? But the yellow is just giving you a warning sign to say, hey, you know, we're going to change direction, all right? We're going to have to come to a stop, right? So that's essentially what a moving average is. Okay, breaking above is just a bullish signal. It doesn't tell you anything yet. You have to wait for a close above and then another open above. Then you have a better sense, a better confidence, a better level of confidence that, you know, price is doing a bullish crossover. Okay, so you see, when price actually closes above and opens above, all right, let me just erase our drawing. When price closes above and opens above, right, you get a confirmation that price has just crossed over, all right, has done a bullish crossover to the upside above the moving average. All right, are you guys clear about the crossover for those of you who are new? Okay, now on the flip side, all right, we have a bearish price crossover. So it's the opposite. It's the opposite. Okay, so bearish. All right, so yes, Vincent, you're right. Okay, so like Bitcoin on the daily time frame, 200 moving average. All right, so that's right. Okay, so bearish crossover is when price is in an uptrend. Okay, so you have higher lows and you have higher highs. All right, so price is in an uptrend. When you load the moving average, it just shows you a smoother direction of the market. So it's the exact opposite of a bullish crossover, right? So bearish signal given when price falls below the moving average, but similar to the bullish crossover, we need a close and an open below the moving average before we can confirm that price is swinging the other way. Okay, so for Fernandez, for the crossover, what is the moving average number? Is it at 200? Okay, right now over here is for illustration purposes only, right? There is no number for this moving average. If there's time later, I'll actually show you guys on the chart, right? Moving average, okay, how when you change the different moving average, right? How the charts will actually show when the crossover happens. Okay, so ideally the bigger the number of the moving average, right? Let me just write over here. Bigger MA, the bigger number of the moving average, okay, the longer it takes for price to cross over, right? The smaller the moving average, give me a moment. I just want to write this down. You guys can take a screenshot of this. All right, both has its pros and cons. All right, the bigger the moving average, right? The bigger the value of the moving average, okay? It takes a longer time for price to confirm the crossover. However, when price actually confirms the crossover, you know, okay, with a greater certainty that, you know, the trend has changed. The danger here is you may be at the end of the trend already. All right, so you have missed a big chunk of the moves. All right. On the flip side, the smaller moving average will make it more sensitive to current price. Okay, so it takes a shorter time for price to actually cross over the moving average. All right, so the good thing is that you get in early on the move. However, the risk is that, you know, it could be a fake crossover, right? So price could just give you a fake signal. You may end up taking more of a loss. All right, so it's really dependent on the trader itself, himself or herself, right? What is the value of the moving average that you would like to use? Okay, so now we move on. That was for the single moving average. Let me just hurry pull up the chart just to show you guys. So over here, we actually have euro dollar, right? And I have euro dollar. I'm just going to put euro dollar on the 4 hour. Right, so you can see very recently price is actually on a downtrend. Right, you can load up a moving average. Okay, whether you want to use moving average exponential or moving average is fine. For this session's purpose, I will use the moving average, the normal moving average. Right, so you have multiple settings over here. I'm just going to use a blue line and make it a bit thicker so you can see. Right, and like I said, I want to use a simple number. I normally use 21. Right, so you can see that price is actually on a downtrend. Right, the moving average is going down. Right, but when the market over here is somewhat in a sideways motion. Okay, sideways. That's why you see price chopping around moving average. All right, only when price is in a strong downtrend, okay, you see that price is clearly below moving average and it works well. But the moment price is in a sideways motion, it chops around moving average, it doesn't work very well. Okay, and you can also see that when we have this is a 21. All right, remember the blue line is a 21 moving average. I'm going to put another moving average. Okay, and this time round I'm going to use it as orange. Okay, let me just find orange, make it a bit thicker. Okay, and I'm going to use a bigger number, let's say 100 moving average. You can tell, right, that, you know, price, okay, you can see over here. Okay, you can see over here. Let's take this point, for example. When just using the blue line alone, when price, okay, if using a blue line, sorry, give me a moment, I need to set this right. Okay, When using the blue line alone, you can see that price actually confirms, okay, the downtrend by breaking over here, right? Price broke below the downtrend. There's a close and there's an open below the moving average over here, right? So it breaks below, tests, it drops further. So the downtrend is actually confirmed in this area. So I'm going to draw a blue line, or rather a blue arrow. Give me a moment. Okay, so this is where, if you are using a smaller number moving average, this is where you enter your trade. Now we look at the orange one, okay? The orange one, right, confirms over here at this drop over here, right? So the orange one, there's actually a significant lag, right? Orange color, right? Okay, so the orange one covers over, crosses below over here, right? You can see that the blue, if you follow the blue moving average, you actually get in on the move earlier. All right. If you follow the orange moving average, I'm just going to zoom in. If you follow the orange moving average, you get in on the move later, right? And if price comes all the way back up, okay, price comes all the way back up, you will be sitting on floating losses before price drops. And this is the part that would actually unnerve quite a number of new traders, right? When price moves against you, you'll be like, oh no, it's above now, right? And I think, you know, I'm going to lose money because price is going to go long. However, if you enter on the blue line, right, the blue line over here, you don't have to worry because the losses are minimal. But if you enter on the orange line over here, all right, the losses is actually quite a bit, right? This huge spike over here. But either way, both, you get to ride the trend down all the way down until it crosses above over here again. All right, so that's a good and bad part about long-term moving average, right? Like 100, or short-term moving average like 21. Okay, so it's very different. All right, the blue moving average will tell you to exit the trade over here because price has opened, has closed above and opened higher and moved higher, right? So blue will tell you to exit the trade here, take profit, whereas the orange will tell you to continue holding all the way until the end over here as well. All right, so it really depends on how a trader actually uses the moving average to his or her advantage, right? It's pros and cons. It's up to you. The discretion is entirely up to you. All right, so that was looking at the single moving average. Now I'm just going to speed things up a bit because we got quite a bit to cover. All right, and then there's the interpretation of a double crossover, right? Essentially, a double crossover is just using two moving averages on the chart to generate a more accurate signal. This is called a crossover method, right? So it uses one short moving average and one long moving average. So in our example just now, we use the short moving average is 21, the long moving average is 100, right? So we can actually use 21 and 100, right? And we compare it, okay? So when 21, okay, so an example given here is 5-day and 20-day for short-term trading. Long-term trading, you can use 50-day and 200-day, right? Again, very arbitrary numbers. You need to understand why you're using it before you actually use it, okay? It's just like if I give you an X to chop down a tree, right? You cannot just anyhow use the back of an X to chop, right? You need to understand why you have to use the sharp edge rather than the blunt edge, okay? So how do we interpret the double bullish crossover, right? Let's say price is in a downwards trend again. We have this moving average, the short term, the long term one, and then we have a one that's more sensitive, which is a short term one in red over here. Now, when the red crosses, when the short term crosses, I'm just going to write down short term and long term. If not, it's going to get confusing. So this is short term, this is long term, right? Black is long term, right? When the short term crosses above the long term, right? It crosses above from below, right? So it goes up, it crosses above from below. All right, this is what we call a golden cross. Okay, so when it crosses over, this is where ideally you want to enter your trade. You hit buy and you ride the trend upwards. All right, that's ideally what you want. Okay, so over here it says golden cross. Okay, the opposite side is true as well for a bearish crossover. Price is on an uptrend. You have a long-term moving average and the short-term one, right? So you have short-term and the long-term, and you can see, right, when the short-term crosses below the long-term, right? It crosses below the long-term, right? This is where you have the word death cross. Okay, and then after that, you sell over here, you sell at this point, right? And then after that, you write the trend downwards. Okay, so that's essentially how we use the moving average crossover, right? So if we go back to the chart very quickly, using our example, right? This was the entry level. This was the entry level that we saw. Okay, if we were to use this crossover, right? We will not enter here, neither will we enter here. We will enter at a point of a crossover. So we will enter at this level over here. All right, I'm just going to put a bearish arrow. Sorry, bearish arrow for red. All right, this is the point that we will enter. Okay, so your stop loss, depending on where you're going to put it. But either way, price is going to swing against you quite a bit. All right, it's going to go higher a bit. And then after, it's just going to go all the way down. And then where do you take profit? Right, if you just follow the blue moving average, you'll take profit here. Right, your take profit will only be, let's say you enter over here, your take profit will only be 283 pips. Right, but if you are going to follow the crossover, right, you exit. Okay, you exit in this, you exit over here. Right, you exit over here. Let's see what your take profit is going to be. You start from here and your take profit, oh, sorry. And your take profit, you exit over here. Oh, wait, sorry. Yeah, got to be accurate. So this line here, all right, you exit here, right here on the close, right? Your profit is going to be 331 pips. So you're about 50 pips more than somebody who just follows one moving average. Okay, now the downside is this. All right, the downside is this. All right, what happens? Okay, if price does something like that. Okay, if price, I'm just trying to find an example. Give me a moment. I'm trying to find an example over here. Okay, yeah. What happens if it's something like this? You enter over here, right? You enter over here for sell. So this is your sell. All right. So this area here, this close here is your sell. Yeah, your sell. You want to short, right? You want to go short. So you play down. You play down. However, price comes all the way back up and crosses over here. Right. So this is the place where price crosses. So you get out of your position over here, right? Immediately you're taking a very huge loss, right? This is your entry. Okay, this is your entry. And this is your exit. All right, so this is an example of why, okay, the moving average crossovers may not work. Okay, especially when price has this kind of wild swings. All right, and this is on the 4 hour, so it's already not a very noisy chart. Imagine if you were to trade on the 30-minute or on the 1 hour, it's going to be a lot worse. All right, so this is essentially the downside of the moving average crossover. Okay, when it works really, really beautifully. You can actually write the entire trend, but when it doesn't work, all right, the losses are relatively huge as well. So at this point in time, any questions that you guys have about moving average crossover? Okay, if there are no questions, then I will move on to the hamburger, the juicy part of today's webinar, right? Which is the how we actually look at the moving average ribbon, okay, and how we can apply Mr. Avrami's ribbon strategy to the moving average ribbon. All right, so let's say we have price, okay, on an uptrend over here. Now, how do we construct the moving average ribbon? Okay, moving average ribbon is constructed by combining 10. If you actually look at the charting platforms that you have, sometimes they use even more than 10 moving averages, right? However, I always believe that too many cooks spoil the broth, right? So you shouldn't have too many indicators on your chart. It can be very confusing. Okay, so moving average ribbon is constructed by, over here on the slides for presentation purposes, it's constructed by combining 10 moving averages. So they break it into two groups of 5. The first 5 are short-term moving averages where we can use 4 7, 11, 14, and 17 as moving average. All right. So these are the short term. The rate is the short term. Okay. And then after that, the next group, we have the long-term moving averages, all right, which uses the values of 30, 35, 40, 45, 50. So those are the green lines. Okay. So the short-term averages, the short-term moving average group represents short-term traders or speculators' view of the market. And the long-term averages groups, the long-term moving average group represents the long-term traders or investors' view of the market. All right, so the idea is that using moving average ribbon, you can actually look at how the short-term traders and the long-term traders are positioning themselves in the markets. Okay, so with that, we actually form what we call the moving average ribbon. So now let me go over to the chart and I will show you, just load up a random moving average ribbon strategy. Okay, wait, ribbon. Okay, so it's called the MA ribbon. When you click, you can suddenly see, all right, if I were to set the, okay, so over here, you only have 4, right? Over here, you only have 4. You have moving average number 1, moving average number 2, right? So there's only 4. However, there are others customizable one out there that can be quite nice. Okay, so you can look at this one, moving average. Okay, you can see you have many lines here. Okay, so it's just sort of like a wave pattern up and down. All right, and again, whether you are using 1, 2, 3, or 10, or even 20, or even 50, or even 100 moving averages, a bit crazy, but okay. End of the day, always remember, it goes back to the first principle. Moving average can only be used effectively in a trending market. All right, in a sideways market, it is essentially where you're going to get chopped. It's essentially when your moving average is going to work out terribly badly for you. All right, so now that we understand the moving average, let's move on to filtering for entries and exits. All right, in order to filter for entry and exit, Mr. Avramis here would actually want you to first understand the anatomy of a candlestick, right? So this is important for to understand so that you are able to use the anatomy, what do you call that? The moving average ribbon strategy well enough. All right, so let's look at a candlestick. So this is a green candlestick, okay? A candle is made out of a rectangular part which really represents the distance between the open and close, called the body. So over here you have the open and you have the close, which is higher. So it's green because price actually open lower and push higher. And then the shadows are what we call the wick, all right? Or we can also call it a shadow. And then you have the high and the low. So first and foremost, all right, when analyzing a candlestick, what you want to look at is the color of the body. A green candle is bullish, all right? Sometimes people use white color or blue color, right? While a red candle is bearish, okay? So you can tell that the open and close of the red candle is different from the green candle, right? The red candle opens at this level and price push down, so it closes at that level. Okay, the green candle is really just the opposite. Let me just show you. Okay, the green candle is the other way around. You open here and then you close higher. All right, so there is a visible difference. Okay, and the next thing that you want to pay attention to, the next element, is actually the size of the body, right? A larger body indicates, okay, theoretically speaking, a larger body indicates, that either buyers or sellers are winning. So for example, a large red candle here shows that sellers were clearly in control for that session. A small candlestick represents a consolidation of price. All right, it means that there's no real winner between buyers and sellers. Price is really trading within a very tight range. Okay, the third element of the candlestick that is important is the shadows, or otherwise known as the wick. Right, the longer the shadow, the more volatile the price action. Okay, so how this works is looking at a bullish candle, right? It means that price opened at this session, then price went down low, it just dropped low, right? before shooting up all the way to the high and then immediately pulling back down to the close. All right, so in a line chart, you'll see something like this. So if the shadow is very long, right, essentially what it means is price has gone all the way up and immediately rejected, right? So that is why we have such a long wick. Okay, so you have a long upper shadow, you have a short lower shadow. Okay, so if we know the anatomy of a candlestick, we can actually use the body of a candlestick for entry and exits. So how do we do that? Right, when we want to enter a long position, we can buy, all right, above the high of the candle, right? So this is what we call a breakout buy. Okay, so we wait for price to break out and then we buy. All right, so this is for the newer traders. If you're new, ideally you want to use a buy stop order. Okay, if you're more experienced, then you are probably wait for pullback to a better level, right? And then buy. So you actually get a better price. So that is a buy limit order. So it's a bit different, okay? It's very different, right? But for new people, I recommend to use a buy stop order, right? So we buy above when there's a breakout, okay? And when we want to enter a short position, okay, we sell, again, same thing, we sell when there's a breakout. All right. So that is how we do a sell and a buy order, right? Breakout buy, breakout sell, okay, based on the candlestick. Okay, so moving average ribbon strategies. Now, we're going to share some strategies from Mr. Abramis. Okay, so first, let's look at a strong bullish reversal. Right now, let's say price is trading sideways. You have very ugly price action, right? It's chopping all around the moving average, right? Again, moving averages do not work in a sideways consolidation market. So the first condition, all short-term moving average cross from below to above all long-term moving average. Okay, so you have a short-term, the short-term is red, remember. You need to see all 5 of it, right? Crossing above all 5 of the long-term moving average. Okay, so that's the first condition fulfilled. Second condition, right? So the short-term moving averages are all positively aligned. So in this 5 moving average, the top should be the four period moving average, right? So it should be something like that. Followed by the 7 period moving average, all right? Followed by the 11 period moving average, followed by the 14, followed by the 17, right? So this is a condition 2. If let's say instead of seeing this moving averages line up like that, okay, you have the 4 moving average, something like that, okay, and then after that you have the 7 over here, and then you have the 11 that is just sorry, let me just erase all this. Okay, so let's say you have the 11 moving average, okay, and then you have the 14 moving average, and then of course we have the 17 moving average, okay, and then you have the 4 MA over here that's crossed over, but your 7 moving average is only just above over here in between, right? Then this will mean that condition 2 has not been met. It's a failed condition 2. All right, what you want is really for them to line up very nicely together. Okay, and finally, condition 3, all moving averages are near each other, forming a very narrow ribbon. So you can see that the ribbon here is very narrow, it's very tight, right? You don't see the ribbons opening wider. Okay, you don't see a ribbons opening wider, the short term and then the long term, something like that. All right, it's not so wide. Okay, so you want it to be close, you don't want it to be wide. All right, and then the entry is activated above the high of the candle, right? So when condition 1, 2, and 3 are all met, right, then you have a breakout entry over here. Sorry, yeah, breakout entry, breakout buy. Okay, breakout buy. All right, so once price opens above, you can see the buy. Okay, and then the stop loss, you can have it. Okay, the stop loss can be placed below the ribbon. So over here, they put it here. All right, you can actually put it just right below the ribbon if you want. Okay, keep a tight stop loss, right? And then maybe your take profit is somewhere higher. And then you can see price goes all the way up to the take profit, and that's when the moving average ribbons opens more. right? And then you can actually have a very nice risk reward trade. All right, so this is a bullish reversal. These are the 3 conditions to be met. And then, of course, you have the entry signal. All right, so I'll leave it here a bit, right, for you guys to take a screenshot if you guys want to play around with this Mr. Avramis ribbon strategy. All right, meanwhile, for those of you who are done taking screenshots, do you guys have any questions? All right, there are some questions here. For what time frame? So Usman is asking, for what time frame chart should I use for short-term and long-term trade? Right. Okay, Usman, if you ask me, right, as a short-term trader, I would have to define it first. Okay, over here, your definition. All right, I do not know what you're referring to as a short-term trader. A short-term trader can be a scalper, can be an intraday trader. Right. So if you're a scalper, I would advise you to take a look at the 5-minute, 15-minute, 30-minute chart. Okay, if you're an intraday trader, I will advise you to take a look at a 30-minute, 1 hour, 4 hour chart. Right. If you're a long-term trader, okay, if you're like me, a swing trader, then ideally I look at the the weekly, the daily, and the 4-hour chart, sometimes the 1 hour, right? If you are long-term position trend trader, right, then you're gonna have to look at a monthly, weekly, daily, and 4 hours. All right, so Usman, I hope that answers your question. Okay, let's move on to the next strategy. The opposite of a strong bullish reversal is a strong bearish reversal. So conditions are more or less similar. First condition is all short-term moving averages has to cross from above, right? So it has to cross from above to below, right? The long-term moving average. So you see over here, it crosses below. Second condition is that the moving averages must be aligned properly. So the lowest should be the 4 MA, followed by the 7, followed by the 11, followed by the 14, followed by the 17. Okay, it has to be in this particular order when it's downtrend. All right, if not, condition 2 is not fulfilled. All right, and then of course, finally, condition 3, they need to be tightly packed together. All right, not like just now when we see that it's all widely spaced out. All right, so once condition 1, 2, and 3 has been fulfilled, what do? Okay, the entry is activated below the low of the candle, of the breakout candle, right? So this is a breakout sell. Breakout sell. All right. And then the stop loss, you can either put it above the ribbon. You can put your stop loss above here, above the ribbon. Right, sorry, stop loss. This is L, not number 4. Okay, or you can put your stop loss higher. Right, to give your trade a bit of room to breathe. All right, and then of course the take profit all the way down wherever you want it to be, right? As long as you're riding the trend. Okay, so that is a strong bearish reversal. All right, so we have strong bullish reversal, strong bearish reversal. Now let's look at a weak bullish reversal. So it's weak. Okay, so what is the condition for a weak bullish reversal? Condition number 1. All right, similar to condition the bullish strong bullish reversal. All short-term moving averages cross from below to above all long-term moving averages. So you still need to have a crossover, right? So this is the same for all, whether for strong or weak. All right, condition number 1 is the same for all strategies. Condition number 2 is also the same for all strategies. All right, the moving averages must be aligned. If you're bullish, all right, then the 4 MA has to be higher than the 7, has to be higher than the 11, has to be higher than the 14, has to be higher than the 17. All right, so it has to be lined up like that. All right, so this is also the same across all reversal patterns, whether strong or weak. Okay, condition number 3, all right, is that the ribbon is a lot wider. So let me erase all. Okay, so instead of a small compact ribbon band, like previously, all right, the moving averages are allowed to be wider from each other this time. Okay, so once condition 1, 2, and 3 are met, okay, only 3 is unique to the weak and strong bullish reversal. All right, so strong reversals, you need it to be tightly packed. Weak reversals, they can be far from each other. All right, the entry signal, same thing, is at the high of the candle, right, above the ribbon. So you can actually enter over here. Okay, so you need a breakout buy. All right, and where the stop loss is, the stop loss, you place it below the last ribbon, right? So you can place it over here. Right, immediately you can see that you're actually risking quite a bit. This is your risk. All right, you're risking quite a bit. If your take profit is here, might not be the best trade because the risk reward is 1:1. Right, so you have buy, you have stop loss, right? And then you wait for price to go higher, right? So over here, price seems to come back down, right? So it's a weak bullish reversal. So you're not going to have it's not going to be a high conviction trade, okay? All right, any questions for weak bullish reversal? All right, the opposite is true, okay, for the weak bearish reversal. Okay, we are in a downtrend, right? Condition number 1, like I said, is all the same, okay? So the short moving averages has to cross below all the long-term moving averages, all right? And then condition number 2 is also the same. They have to line up very nicely in a bearish environment. 4 MA is below, followed by 7, and then higher will be 11, and then 14, and finally 17. All right, so it has to be in this order. So once condition 1 and 2 is actually once condition 1 and 2 is fulfilled, right? We look for condition 3, which is that moving averages are far from each other, right? So you have a wider band, okay? And very quickly, entry is activated below the candle, right? Below the breakout candle. So here you have breakout sell. And similar, you can put your stop loss outside the ribbon, right? Again, your risk is significantly larger. So your sell is there, your stop loss is there, right? And then price drops, right? But over here, all right, you see that you will be floating in a bit of a loss first. All right, but price doesn't fail to take you out. Price drops further down and you are actually back at break even. Again, this is a weak bearish reversal. So I would always recommend, right? It's always better to sit and wait for a good trade rather than, catching those small fish, right? So you don't really want to catch the small fishes. You want to catch the big fish. All right, now we move on to another unique strategy called the knot. Okay, a knot entry is given when the following signals are met. So you have market in an uptrend following a consolidation. So price is in an uptrend and then it goes into a consolidation. So you need an extreme consolidation of all 10 moving averages in one particular area. So you see price is actually whipsawing around the moving average. Okay. So sideways price consolidation is making the moving average creating a knot. So basically just very messy, a whole clump over there, right? So condition 1 is all moving averages is in one area. Condition 2 is they are all crossing around, making a knot. After a knot in the ribbon, a volatile and large price movement is expected. So this is really what we are waiting for. We're waiting for a large price movement, okay? So entry signal is placed above the most recent top and a sell signal is placed below a most recent low. So you actually have a breakout buy over here. If you want to be safe, you can have a breakout buy and then you can actually have a breakout sell. So you're actually playing both directions, right? A breakout buy, breakout sell. Okay, you can put it over here or you can put it over here. Doesn't matter as long as it's below, right, the candlesticks. Okay, and then the stop loss is the opposite side, right? So let's say you have a breakout buy here. your stop loss, this will become your stop loss, right? And let's say you have a breakout sell, this will become your stop loss. This is what we call the straddle. All right, so there's a straddle. For those of you who trade options, right, there's also a straddle strategy for options. Slightly similar idea, but different way of executing it. Okay. Okay, now we move to another, that was the knot strategy. Now we'll move to another strategy called the bullish alignment. All right, so let's say price is in an uptrend, right? Bullish alignment signal is given when the following conditions are met. Condition 1 is all short-term moving averages are above all long-term moving averages. So this is all above, right? Like the reversal signal, okay, the moving averages have to be positively aligned. But condition 3 is different, right? Condition 3 is that, okay, the moving averages of the short term, right? So this refers to the short term only, the short term moving averages are forming a narrow ribbon, right? Previously, it was both the long term and the short term that forms a narrow ribbon, but now you're just looking at the short term forming a narrow ribbon. And then finally, so this is a slightly more high risk entry, right? You can enter breakout high, breakout buy above the high of the candle. So your breakout buy can be here. Okay. And the stop loss can be placed below the ribbon, right? So somewhere here, as long as it's below the ribbon. Okay, and then you ride the trend upwards. All right. So that's for bullish alignment. And finally, we have bearish alignment. Bearish alignment is essentially the opposite, right? Price is going lower, right? You have a long-term moving average, short-term moving average below all long-term, okay? And the alignment is proper, right? You have actually, they are aligned properly. And then, of course, condition 3 is a bit different. The band here of the short-term is narrow. Once all this condition 1, 2, 3 is fulfilled, you have a breakout sell here. And of course, your stop loss is outside the ribbon. Or you can put it at the last ribbon as well, but we always try to give our trades a bit of room to breathe. So you put it outside the ribbon. You have a sell and you have the stop loss. And then you ride the trend downwards. Okay, so a lot of strategy. Now, this other strategy that we're going to cover, so that was the bullish and bearish alignment, right? This is the bullish waterfall exit. Okay, waterfall exit, how does it work? It looks like a waterfall. Imagine it's a waterfall. Okay, so condition 1 is that all short-term moving averages are above the long-term again, right? But this time round, right, even though they are positively aligned, okay, all right, you can see this, right? Even though they are positively aligned, you need to first look at the 4th period moving average. So you are focusing on the 4th period moving average. It crosses below the 7 and the 11. Okay, so you need to see that they are positively aligned. Right over here is 4, 7, 11, 14, 17. But over here, the alignment will be, right, something like 17. Okay, you will probably have something like, I'm thinking 17, yeah, okay, 17, 14, all right, and then you have 11, right? You should see the 4 below the 7 and the 11, okay? So something like the 4, so it crosses over, right? Or you can also have the 14, haven't turned over yet, 17, okay, 11, 7, 4. All right, as long as condition 2 and condition 3 is fulfilled, right, you get to enter in, right, on the bullish waterfall exit. All right, so exit signal is the same thing, all right, below the low of a candle. Once condition 1, 2, 3 is fulfilled, all right, your exit signal, your sell is here. Okay, your breakout sell. All right, your stop loss, you actually put it at the last swing high. Okay, you put it at last swing high to protect yourself. All right, and it's a waterfall, right? Price drops a lot lower. Okay, the bearish waterfall exit is just the opposite, right? It's really just the opposite. Okay, same thing, condition 1, short-term moving average is all below the long-term moving average. And then condition 2, they are negatively aligned in this area here. And condition 3, 4-period moving average, you can see is starting to cross above the 7 and the 11, right? And once you have condition 1, 2, 3, same thing, you have a breakout buy over here. Right, this is a bearish waterfall exit, so it's exit of the waterfall, right? And then you can put your stop loss over here, right? And you can play the reversal. All right, but sometimes it might be wiser to wait for something like that, right? Something like that. You wait for this kind of alignment, right? And then your stop loss, and then you're more guaranteed of a better push. All right, are you guys clear about this? Okay, so we don't really have much time to go through the charts, but I just want to tell you guys that at the end of the day, when using the moving average ribbon strategy, okay, the idea is that you don't eat the head and you don't eat the tails, okay, whether head and shoulders, right? You want to wait for a clear breakout, a clear reversal of the moving average, all right, before actually entering the trade. All right, so are you guys clear on this? Okay, with that, we have actually come to the end of today's session. All right, so these are just some of the details. If you want to get in touch with Tradepedia, Mr. Avramis Despotis, and ask him more about his Avramis ribbon, right, you can definitely reach out through these channels. Otherwise, I'm going to leave the webinar room open for a couple of minutes, right, 2 to 3 minutes, to see whether you guys have any questions at all. All right, so feel free to ask any questions.
Yeah, I'm happy that you came with me. I'm sorry if I tear up. The rules were yours, you will always make me tear up. Taking movie videos, walking through the park. You would jump into my arms every time you heard the bark. Cuddle in your sheets, say me sound asleep.
Okay, hi Sean. So you have a question here. You're actually asking, when I mentioned 4, 7, 11, 14, 17, what do these numbers represent? All right, again, right from the start, I've said, if we're going to use moving average, right, we need to first understand what the numbers are. Okay, so right now, this is actually Mr. Avramis' ribbon strategy. So I really have no idea. I have to be honest. I have no idea why he's actually using such numbers. Okay, but I'm sure based on his back testing, okay, if I were to go back to the slides, right, if I were to go back to the slides, let me just show you over here. Okay, when he's using the short-term moving average, right, the idea is that he wants to use the short-term moving average to represent the short-term traders in the market. Okay, so that's why he uses 4, 7, 11, 14, 17. Okay, now my view, my own personal view is that when we're actually using moving average, we need to understand why we're using moving average of that number. For example, why do people use 200-day moving average, right? There is really no reason apart from the fact that it is an arbitrary number. Everybody is looking at it. And because everybody is looking at it, it makes sense for everyone else to look at it, right? So it becomes a self-fulfilling prophecy that a 200-day moving average is actually very powerful. But if you want to be more accurate, right, some people argue, oh, 200 days is actually the rough average number of trading days that you have in a year, right? However, if you really want to be accurate, right, the number of trading days that you actually have in a year is, I think, 262 days. Okay, so 200 days moving average and 262 days, very, very different, right? So yeah, if you ask me to be more accurate, more representative of the number of trading days that you have in a year, right, then 262 days, 262 as a moving average period would definitely make more sense. Okay, so this system here, the moving average ribbon, is actually done by Mr. Avramis, right? So he probably has a clear idea of why he uses those numbers. Otherwise, Sean, for you need to play around with the numbers to see really what works for you. All right, for me, I use Fibonacci numbers, okay, because the methodology that we have at Everest Fortune Group is that Fibonacci is that markets follow a fractal nature, right? So fractal market hypothesis, right? It is actually a proper research study that has been done on it. Okay, and I think behavioral finance is starting to include it into their syllabus as well. So when we use Fibonacci, Fibonacci follows the fractal nature, right? And fractal nature can be applied to the financial markets. That is why it makes sense to use the Fibonacci numbers for moving average. As compared to, you know, if you're going to use, let's say, use a 2-day moving average on the daily chart, then you're going to, and then on the 1-day moving average, you're going to have to change the 2-day moving average to 48. 48 moving average, right? Because you are looking back at 2 days means 48 on the 1 hour is 48 hours, right? So you're going to have to change your moving average accordingly. However, Fibonacci moving average, actually using Fibonacci numbers actually helps you avoid that because of the fractal nature that Fibonacci carries along with it. All right, Sean, so I hope I answered your question. I gave you a bit of a lengthy explanation, but I just hope it's a bit more clear. Just trying to tell you that at the end of the day, it's discretionary. You need to understand, as a user of moving average, you need to know why you're choosing those numbers to start with. Yes, Sean. So the number that I represent, the number that I use for moving average, ideally is supposed to represent the number of days, right? Because that was really how moving average first started out. It was used in the stock market to really just calculate the number of days of trading, right? Because last time people didn't really look at a 1 hour, 15 minutes chart. This sort of data was not readily available for the retail crowd. So I hope that answers your question as well. All right, so with that, we have run out of time. All right, thanks so much, everyone, for taking time out of your Tuesday morning after the long weekend to join me for today's webinar. Just want to wish you guys all the best. Trade safe, stay safe. Okay, and we'll catch you guys again for our exclusive webinar tomorrow. All right, so remember to go over to the XM website to register for it, and I'll catch you guys again. So take care and goodbye. You're welcome, William. Welcome, everyone. All right, catch you guys again. Have a great day. Have a good lunch ahead.